For C corporations, charitable contributions are a special deduction with a hard cap. The starting point is taxable income before the charitable deduction. Then you apply the limit. Generally, only up to 10% of that taxable income is deductible this year. Anything above the limit doesn't disappear automatically. It becomes a carryover. On the EA exam, they love testing the order. Compute taxable income first, then apply the 10% cap. When a corporation gives more than the 10% limit, the excess carries forward up to 5 years. There is no carryback for charitable contributions, and the carryover isn't guaranteed. You can only use it in a future year if you have taxable income and room under that year's 10% limit. After the 5-year window, any unused carryover expires. That use it or lose it ending is a common exam trap. Here's the other big limiter. Charitable contributions can't create or increase a net operating loss. So if taxable income is 0, the current year charitable deduction is 0. The contribution doesn't vanish, it generally becomes carryover, but you still can't use it in a way that pushes taxable income below 0. On exam questions, watch for language like before charitable contributions and null in the same fact pattern. Let's run the classic calculation. Turnkey Media donates $35,000 cash to a qualified charity. Taxable income before the charitable deduction is $95,000. The limit is 10% of $95,000, so only $9,500 is deductible this year. The remaining $25,500 becomes a charitable contribution carryover for up to 5 years, still subject to each year's 10% cap and the no-null rule. Now, timing. Cash method corporations deduct charitable contributions when paid. Accrual method corporations get a special timing rule. They can deduct an unpaid contribution in the current year if 2 things happen. 1, the board of directors authorizes it during the year. 2, it's paid by the return due date, not including extensions, and you need a statement with the board resolution date attached to the return. The exam loves that no extensions detail. Example: Healthline Medical is accrual basis, calendar year. The board approves a $5,000 donation on December 15, 2024. Healthline can deduct it on the 2024 return as long as it pays by the original due date of the return, generally April 15, 2025, for a calendar year C Corp return due date rules tested on the exam. If they pay after that original due date, the deduction shifts to the payment year. Malcolm is a realtor filing Schedule C. During the year, he gives business gifts: a $50 bottle of champagne to client 1, a $40 bottle of wine to client 2, a $30 pair of earrings to client 2's spouse, and a $28 box of chocolates to client 3. He also spent $35 on packaging and shipping. How much can he deduct for business gifts? The options include $110, $135, $183, and $153. Think about it. The correct answer is $110. Business gifts are limited to $25 per recipient per year. Client 1 is capped at $25. Client 2 is capped at $25, and the spouse gift counts as an indirect gift to that same client. Client 3 is capped at $25. Packaging and shipping are incidental costs and aren't subject to the $25 cap, so add $35. A tempting wrong answer is $135 if you forget the $25 limit. Cedar Valley Foods is a fiscal year C corporation using the accrual method. Which requirement must be met for the company to deduct an expense? Some choices focus on paying before year-end, paying first, receiving an invoice, or meeting the all events test and economic performance. Think about it. The correct answer is that Cedar Valley must meet the all events test and have economic performance to deduct the expense. Under accrual accounting, payment isn't automatically required, and an invoice by itself doesn't control deductibility. The tempting wrong choice is the one about receiving a bill because it feels like proof, but the tax rule is all events plus economic performance.